We're waiting for something from the seller to pass to the insurance so the insurance can send something back to us so that we can do something with our underwriting that can produce a number so that we can talk to investors.
Exactly. That's going on 15 different angles at the same time.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
Hello, everybody. Welcome back into an episode of the Get Invested podcast. As always, we're your hosts, Jordan and Matthias, and we're excited to be here to talk investing, real estate, and real estate investing. As we're recording, our last release one was the HOA one, which I got to say, I enjoyed making that one a lot. I don't know if anybody else will enjoy listening to it, but I had fun with it. I was hoping to get some riled up people responding, but not yet, at least not on my end. But today we are back on that real estate investing game. We're going to talk about the capital raise timeline. Now, this is something we've talked about before. This is going to be an overlapping one, but we are going to be taking a particular angle, and I'm going to come back to that though, Matthias. So I want you to kind of launch us in here where we're going, but I want to just make a couple clarifications.
So the capital raise timeline is basically talking through whenever we're raising funds to acquire a new property, what it looks like, kind of correlating what the investors hear from us and what we're doing during that time, like kind of a timeline basically of what's going on and when they hear stuff and what, maybe a little bit of we've talked about it, but a little bit of explanation on why the timeline is what it is.
I just wanted to make clear that we are going to kind of cross over due diligence. Which is something we've definitely discussed more than once. That's going to come up, but that's not the focus. We are going to cross over investor communication, which the last time we talked about this, we were really focused on planning how it is that we communicate to investors in order to comply and do raises that are 506B compliant to new investors. So that is a part of this as well, but we are hopefully, as well as we can, going to stick straight to what's happening on our end, coordination, kind of milestones, timelines. It's a pretty good follow-up to 2 weeks ago's newsletter where Matthias is talking about waiting for institutions to get back to him, because that is going to be a big part of the story as well.
A lot of that.
So the way I'm thinking about this, Matthias, is if ever someone who has listened has been a part of, a real estate private equity investment, and, they heard that there was an opportunity coming. And then from the moment that they heard that to the moment they actually sent their funds, if they were told that, yes, we now acquired the property, was somewhere between 6 weeks to 2 months. We are here to explain why.
If not more sometimes, yeah.
Yeah, we're here to explain why.
Yeah.
So let's, I guess, start from the beginning.
Yeah. So at the beginning, where, what I'm always looking for deals. So I'm always talking to brokers. They're always sending me stuff. Hey, would you be interested in looking at this? Yes, no, why not? So on. But every now and then we get a good one that we're like, hey, I am interested in this. We'll start a conversation, eventually write an LOI, letter of intent to purchase, send that in. And then we'll, and they could either ignore it, reply, say, hey, somebody else is buying, you've been outbid, whatever. But every now and then they will come back and say, hey, we want to work with you. And we'll do some kind of final negotiations on some terms, potentially price, how long of the contract, some things that are going to be in the contract, whatever, kind of some big items, contingencies that we might put in the contract, that type of stuff. But then eventually we'll get to a place where we're in verbal agreement. And that really is where the timeline starts for when we're like, hey, basically we're going to buy this property, barring any major setbacks. There's this one's a go, basically. So there's a lot of things that we'll set in motion on our end during that time. Typically, it's all getting lenders prepped, sending a bunch of information, asking for insurance quotes, providing as much information as the seller has already given us, and passing that on, and just as soon as possible, because the sooner that we get quotes and the better we can understand the deal, the better, right? Because that gives us more time to be locked in with everything prior to closing. So we start as many timelines as we can. But what's the kind of what starts the notification for the investors comes just a little bit after that. Because sometimes, and it's not always the case, sometimes it'll be just a few days between verbal agreement and contract, but sometimes it could be 2 weeks. It could be, I've seen it take 3 weeks before, where both parties have lawyers looking at the paperwork and making tiny adjustments here and sending it back. Then they make tiny adjustments, say, no, we still want to fight over this, and going back and forth. It's called redlining the contract and saying, nope, we want to strike this out and we want to add this. A lot of that going back and forth. So that's one of the things that's going on before the investors have any idea that there's one coming.
Right. And we went into some detail on that process when we covered purchase and sale agreements. So, and that's what you're referring to, like that kind of back and forth. And it's funny. I mean, even when there were no edits, it still took like almost a week.
Yeah.
Literally a week to get no notes.
So exactly. That's until it's not everything. You just assume good faith that, maybe somebody was traveling, maybe somebody needed their lawyer to come back off of leave. Weekends are involved at times. But anyway, so after that, basically, once the contract is signed by both parties, us as the buyer and the seller, that's when we'll send out notification.
That's kind of
to our investors, say, hey, because now it's official, right? Nobody's going to back out. Nobody's going to, hey, we could not come to an agreement on this point. We'll say, hey, we have a deal under contract. It'll be coming soon. We can't release very much information at that point. We might give some very broad details. Just say, hey, it's coming. Get ready. So on our end, once that contract is signed, it starts obviously an internal timeline for us. That's the due diligence timeline. And so we've talked about this, like you said, multiple times. We've talked about the due diligence, what we're doing, the inspections, the appraisals, the lender doing checking all the leases, verifying that the property is what we thought it was during this period. What the investors really care about is that as the due diligence starts, we also start the legal timeline. So the legal timeline is basically from when we pay the legal fee to start the SEC attorneys drawing up the paperwork. That'll go towards they'll draw up the operating agreement. They'll set up the LLCs. They will draw up the PPM, the private placement memorandum that all the investors will sign on to and buy their shares to the investment. So they start drafting all that stuff based on the information that we give them from the beginning there. But it's not very cheap. So we typically don't start that until the contract is signed, because what we don't want to do is spend the lawyer fee and then not be able to come to that agreement. Kind of the same reason we don't tell the investors.
Right. Yeah.
Go ahead. I just was trying to give a break. I've been talking a lot.
Yeah. Two different kinds of backtracking there. One more expensive than the other, but perhaps the egg on the face could end up being the more expensive.
Yeah, exactly. I'd much rather have an egg in the face than pay $15,000 legal fee and not be able to use it. So during the legal, while they're drawing up all the paperwork, that takes a few weeks. Typically, we are finalizing as much information as we can from the due diligence, from our inspections. We're verifying how much money we think we're going to have to spend to get the property up, so our capital expenditures, reserves, what kind of loan we expect to be able to get. Hopefully, we're getting some preliminary quotes on insurance and all that stuff. So we're verifying a bunch of assumptions before we say, hey, these are the returns we think we can calculate based on everything we know at this point. Once we do that, we build out our what's called the investment summary, investment overview, pitch deck, whatever you want to call it. We're plugging in all the information as we get it to that thing. Once we get that finished, it usually takes a good halfway, 3 weeks. And, due diligence is typically a 30-day period. That's kind of an industry standard. Could go either way, but typically it takes about halfway through due diligence before we're really close to finalizing that investment summary. And what we do before we're allowed to send it out to anybody, which is basically releasing significant details on the property, some projected return percentages, 17%, all these different terms that we've talked about before. We're going to send it to the lawyers and get them to approve the information that we're releasing, making sure that we're not promising, guaranteeing something. They have disclaimers they'll tack on to everything. There's items that you need to have in your investment summary per, SEC case law and stuff like that. So that's what we're doing during that kind of the due diligence. We have legal stuff going on, and the property, verifying that the property is what we thought it was for the investment.
Yeah, let's slow down, back up a little bit here and just talk about a few different things that you mentioned there. First, the kind of process of crossroads, if you will. It's not entirely the word junction. let's say it's a junction point, right?
Okay.
Not conjunction junction. I'm not going to make it a grammar joke.
Schoolhouse Rock.
Yeah. But the junction point of, which is you and me, honestly, of all of these different parties going on. And I was just thinking, because we're in the middle of this kind of thing, that for instance, we want to be able to speak to investors, right? And of course, once we announce, there is the possibility of having high level conversations with people in the pool, right? You're not saying numbers, but you're talking about why you like the property, that kind of thing. But we want to be able to send out something a little bit more concrete than that.
Some enticing details.
Yes.
Why we're excited about it. Yeah.
Right.
What it
And
looks like.
for instance, just take a small instance that kind of you can multiply by, I don't know, about 25 different variations of what we're trying to do and what we're waiting on and whom we're talking to and coordinating to make that happen. For instance, we've had a swimmingly good time in this current acquisition. I would say everyone's been great, but even so, there are a couple things like the loss runs that came a little bit later than some other things, which means that we can't get them to the insurance guy, which means he can't get us a quote, which means we can't plug that quote into the expense, which means we can't project net operating income, which means we can't project any of those investment return metrics that we've discussed a number of times. And that's just one particular financial
line item. Yeah.
Line item, right? That literally just what have they claimed on their insurance to one party that we're coordinating with to get one expense. Now a big one, granted, a big one, but one on that whole calculation. And that, then you take that to the lender and it's, I'm not even going to go into all the documentation that they need, to get even something as straightforward as, I think this is an easier to understand, a quote for an interest rate, which may or may not even be the final interest rate, but just a ballpark. So that again goes into that calculation. So I just wanted to kind of walk through like a step-by-step of a specific instance or two where a number of things have to fall into place.
Yeah.
We're waiting for something from the seller to pass to the insurance so the insurance can send something back to us so that we can do something with our underwriting that can produce a number so that we can talk to investors.
Exactly. So that's going on 15 different angles at the same time. Correct. And even on the potentially, like on the lender side, like the type of loan very much depends on the financials of the property, how the price compares to the financials of the property. And some loans, we've talked about the types of loans before, if it's not performing where it should in relation to its price, your baseline long-term stable debt is not going to lend on that because they need to have the income higher. So you might have to go to a bridge loan where you're going to bridge from buying it to where you can get it to where, you know what I mean? So all these things have to come in and then that determines, the type of loan. And then once you get the type of loan, then you can go get the quotes for, hey, the interest rate, is it going to be interest only? Is it going to be, what amortization, if it's going to, all these different things that are going in, that all, like you said, plug into the metrics, the spreadsheets, if you will, that determine the overall returns based on somebody's investment. Yeah.
And granted, that's what I just went through and reformulated there. That's one of the earliest things. So one of the latest things. So it's kind of encompassing the whole process. But my point was that they're not linear, right? Like there are multiple types of those things going on at any given moment that all have to come into it. And some can come early, some can come late, some can change, which, the timeline can shift is what I'm saying. Right. And then we're the repository of all this information.
Sure.
That has to then get fed into, as you were talking, I was thinking about the pitch deck. If I would assume most people listening to this have seen a pitch deck before, an investment summary, but there's a lot of things going on there. And a lot of them do require a lot of different coordination to get to even one slide having very pertinent information on it.
I do want to take a second here, kind of just to make a little point. We're talking about we don't know the insurance number, we don't know the loan number, all these different things. But really what the due diligence period is for is confirming our assumptions. So I have a good idea of what type of loan I'm going to need, what type of insurance I'm going to get, a general number. I know what it's going to cost generally to operate this property in terms of maintenance, taxes, etc. The reason I'm going to pull the trigger on a property is because I'm assuming a bunch of things, because it's always in a market that I know what to expect. So when I identify a price and some income for our value add strategy, I'm determining I can make a lot more income with this property than what is happening right now. So I'm going to buy at the price for whatever's happening right now and operate it higher, aka value add.
Right.
That's why I pulled the trigger. So it's not that I'm just going in here blind and swinging. I don't want to give off that impression. I have a very good idea of what it's going to be. I have to verify it before I'm comfortable offering that to investors. That's why I wanted to clarify here, is that I know what it should be. There's been times when it's not what it should be and nobody knows why, and you have to back out of the property. We've done that before.
Yeah.
Going, hey, I assume this is what insurance was the case at that time. It was like insurance came in at a huge number, way outside what anybody, lender, insurance guy, anybody was expecting. And so we were like, well, that means we can't buy this property, and so on. So these are the things. And obviously, had I told investors that, hey, we're giving them some number that I couldn't back up, then I've got egg on my face again, per se. So we have a very good idea of what the property is going to be when we get under contract. We are doing verification before, we get some hard data before we start offering details to investors. So that I just wanted to clarify that.
Sure. I mean, and what there is, you do have to verify that it is actually true. Most of that at that point is what you think will be true is true, rather than what you thought was true about the property is true.
Right.
That one is a lot more straightforward to, as long as no one's
like
fudging.
inspections and stuff.
Yeah. As long as no one's doing some really creative accounting that you have to,
which we've seen before too.
Yeah.
Yes.
You have to work through. Those things are pretty okay. Yeah, this is what I thought. I got some of this. I've confirmed but like you said, the insurance thing is what you think it will be from other parties. You have to verify that it will be. But the other thing is, I think that's interesting is there's the verification, but there's also this aspect of you got to show your work, right? It's kind of like back in school, if you're doing math, you
could do it in your head, but
I don't know. Yeah. I mean, I'm sure we both got look bad about this, where you're like, just write the answer down
all the time,
or like really sloppy, skip steps, but got the right answer. You're going to lose some points, right? Because you didn't prove that you know how to get there. Kind of the same thing here. You can't just tell the bank, hey, I'm pretty sure. Right? You have to show, yes, I'm actually correct with here are the things, right? So it's verification on one hand of like, oh, reality matches this. There's I didn't miscalculate, but just something as a surprise, or there was something different than what was presented. But just, yes, all institutions involved. See,
sure, including the investors.
And here is all my steps.
Yeah, exactly. Including investors is like, hey, you guys, I'm going to show you that I'm not just pulling this out of my rear end. I am
exactly.
Here's how I got here and why. So that's that. We'll call that the legal due diligence period. And go ahead.
I'm sorry, there's one thing I wanted to ask, because I've kind of always wondered this.
Sure.
And it's a little bit a tangent, and if it goes too far, I'll just cut it. But it's part of the timeline, because the pitch deck is something that we have to get done before we can, which is the next part, present to investors, kind of start lining it up.
We're getting ready to move on.
We have to send it off to the lawyers. And I want you just maybe go in a little bit more detail about what they're looking for. Because I think anybody who's listened to us a decent amount understands the SEC making sure that we're not making claims that go beyond, making sure that everyone understands exactly what they're walking into, especially in the instances of the early investors. But beyond that, what is it exactly they're looking for? I asked this because one time we got back, most of the notes from the lawyer were suggestions of organization of the pitch, which was not in her purview. And I personally felt affronted as someone who organization of rhetorical thought is kind of my thing. So
sure.
What else are they looking for, and how would that got to that point, I guess?
So there's a few things that they want included that, like I said, per case law, you need to have every fee that the syndication team might be getting or will be getting. Any fee needs to be very clear. Numbers, they want to see, your projections, and they're going to slap the labels of these are projections. There's no way are these guarantees, things like that. But they also and they I vaguely remember the one you're talking about. I didn't take as much affront because it wasn't my work.
That's not your job.
Like I'd plugged in a bunch of stuff, and it's like you organize it however you want. But they'll look at industry standards because they see these all the time, and they're like, hey, they might, as a I don't know, as a tip, they might provide tips and suggestions, like you said, on organization. Just, hey, we've seen people have success doing it this way. And they may or may not provide, explanations as to why it's better to do it, organize it this way or move stuff around. But mainly, they want to make sure we're not making promises. There's income, expenses that they want to see. They want to see the kind of certain breakdowns that they want to see a slide or a chart that shows specifically the sources and uses. So like, hey, where are we getting the money from? Like the loan, investor equity, and then on the other side, hey, what every dollar of that, what are we using it for in terms of the the acquisition of the property, things like that. There's specific numerical data. They're not checking to see that your returns make sense. They're not verifying, hey, our rent comps are this, and they're not doing any of that work. Not fiduciary type things. They're just saying that, hey, these are the numbers that we expect to see. These are all the ways that you're going to get paid. You're not making promises. Those type things is what they're looking for. And they have a specific, I don't have their criteria. And they, whenever we send one in, they may or may not say, hey, good to go, just slap this disclaimer on there. Or they may have, you need to add a page showing this or something like that.
Right. Yeah. The disclaimer thing, it's no issue. That's just, okay, copy paste, put it on there.
Yeah. And they update it over time too. And that's the other thing. Sometimes the criteria that need to go into these investment summaries, sometimes that changes and it develops over time as like cases go on, or SEC may publish some more guidance, some new law may get passed. Who knows? So that's why we pay them, is to make sure that we're compliant with everything. So that's when they will tell us, hey, no, now we have to add this to all of our things or whatever.
It would be interesting to see. It's probably not a nice, neat little checklist, but I bet they have some kind of checklist for someone to go through, but all the different things that they have to look for. I bet there would be some things in there that we would not have thought of that maybe we don't even, that never kind of come on our radar because we're not, for whatever reason, doesn't
outside of our business plan or whatever. Yeah.
Or we are always somehow checking that box, but people often, miss the mark on that or somehow. I don't know. Like, it would be interesting to see, but okay. They've signed off.
Yep, we've corrected whatever they have. So now we have it, and we're ready to send it out to investors. We're excited. Hey guys, we've got a good one. Here it is. So basically, we'll engage, kind of send out to, obviously not to everybody. We don't advertise. We'll send it out to people who are in our investor pool,
personal relationships with us. So
exactly, and any partners that will be doing the same thing to their investor pools. So we'll send it out, and we'll typically schedule a webinar. Give them maybe a week or two to peruse the information, ask any initial questions, but then really we want to get a webinar, get a recording of us talking about the deal and answering like initial questions that people have on a recording, so that we can kind of post that in our investor portal and let people come in at their own leisure. Not everybody has to make the webinar in order to invest or to learn and get their questions answered, but we'll post that. They can watch that whenever they want to. And obviously we'll basically go through the pitch deck or the investment summary on that call. We won't get into nitty-gritty details of market statistics and demographics and anything like that, because that's just easy stuff to read.
Like days putting that together, but we just skip right over it. Don't worry about it. Don't make a big deal about
well, the people theoretically read that on their own time, and it doesn't. There aren't going to be any questions on that, and if the less they want, they can bring those questions. But that's why we send it out to people.
Listen, I'm not undercutting our own work or casting doubt on things, but it is interesting to think about, because we have done episodes where we're like, hey, here are the things you should look for in a good investment summary pitch, plan, right? If you're going to invest and looking at it, and whether it's with us or someone else, when you're doing local market analysis, and this, of course, and I'm sure most people understand this. Well, maybe we all tend to fall. Let me just back up one second. This day and age, we all tend to fall into a trap that we know is there, but we don't really think it all the way through unless it's actionable in front of us, which is that just because information is easy to find doesn't mean that the right information is easy to find. Does that make sense? I think we've talked about this before, but just because you can Google doesn't mean you can find. It's easy to look doesn't mean that it's easy to find, if that makes sense.
I get you. We're
Right.
talking about like information on a specific
Right. So like,
market or something.
yeah, if let's take Gulfport because that's one of our places, right? There's data maybe for the town. There's data for the metropolitan statistical area. There's all these. There's the Chamber of Commerce that may have done some. There's a U.S. Census that may have done some. There's some private organization that's done.
Mm-hmm.
So the information can be scattershot, I guess is what I'm saying. So all of our information is good, and I tell people where it's from. I just want to make that clear. I listed on the bottom. Here's where I found all of this information and what years it pertains to. But I mean, it is just a note that people claim, because part of the investment strength is, hey, this is why we like this market. Now, for us, it's very targeted, which again makes it a little bit more difficult to maybe find some of those sexy stats, if you will.
Sure.
That is something, if you are someone who wants to really do your due diligence on a pitch deck, you could look and see, like, are these sources there? I mean, if you don't trust if something you don't know that way.
Yeah. Well, and also just to go peruse and see what else, is on there. Sure.
Yeah. Because for instance, the Chamber of Commerce for a statistical area does a study and the median income of the area is $80,000. And then the U.S. Census Bureau does one and says the median household is $40,000. And you're like, well, where exactly were they asking? Who answered?
Yeah, what are the boundaries of said area?
Yeah, what's the cross section? What kind of projections, statistical models? I mean, that is a vast difference for the supposedly same area of a state. We're not talking about a huge area either. So, anyway, it would be something interesting to look at if you want to be incredibly thorough.
Yeah, well, I agree. Yeah, so basically at the webinar, and any of our investors who have sat through those, basically we'll go through the basics of the investment, and we'll focus a little bit on the really why we like the property, why we think it's such a good deal. We'll show the numbers. We'll talk about ways that we think. We'll talk about how conservative our projections are. It's like, hey, this is kind of a worst case scenario. We really think we'll beat all these numbers, and explain why. Hey, we think we're going to get the insurance cheaper. We think, we think the income's going to come up faster, or whatever we think. We'll talk about that, and hey, we think we're going to be able to refi, and we never be able to refi into our plan, or all these different things. We'll kind of focus on that, and then we'll focus on kind of some risks. Hey, what do we see? What could be a problem with this? How are we mitigating against, hurricanes or, what have you, any potential risk? And then from there, we really just go to questions, and it's always helpful. I like having those webinars because it's fun hearing the questions from the investors, because there's some ones that I never would have thought to look at, I've heard some crazy ones that don't apply, but there's also some that are just like, hey, we actually looked really close at this, and it's like a really astute question or observation, and it's fun, and we tell, give a little more context, a little bit more story to the property itself when we do the webinar, and get different perspectives and questions from different perspectives from people. That's what we're really looking for in the webinar, and to get that on tape and posted and shared to everybody so that they can hear those questions, that I might jog it might answer questions that they had anyway, but it also might jog their minds and remind them of some questions that they wanted to ask too.
Right. Yeah. So that it's an interesting little line, I guess, because it's good that it can be available for people later to watch, but you really do need enough people there.
Yeah. To get a good smattering of questions.
To have good questions so that when people come afterwards, because I would say, considering we all live these busy lives, the recording probably gets as much play, if not more, than the actual webinar.
Yeah. If
it was only just this moment in time, you had to be there, we would be in trouble. So you do need enough, though, that so when they watch it, whenever the day come along, it has the facsimile of them being there, because questions that they may be thinking of, right, someone else asked. Or someone asks a question, like you said, that leads them to maybe another question. So then they can reach out to you, and that starts a conversation that can be productive. By the way, if we have any younger listeners out there, the phrase "on tape" comes from a time, some archaic, long ago time, when we put video on actual physical special tape that was then played. VHS, movie reels, these kind of things. This is all digital, but just that idiom being what it is.
So following the webinar, during this time, what we're doing is we're starting to field questions. Investors are reading the pitch deck, the investment summary. They're watching the webinar. They're asking their questions, and I'm making phone calls, going, hey, have you looked at it? You got any questions? That kind of stuff. We're doing a lot of that. But in the other side, we're also, like I talked about earlier, the legal team has drawn up the operating agreements and the LLC paperwork and all that stuff. And we've gone and we've reviewed it. And now we've called, hey, we're good, we're finalized. Everybody's going through and signing it on the background. And then we're uploading that into the portal. This is all going on while the webinar and discussions are happening on. So the portal's not open for people, can't actually reserve their spot yet, just because we've had the webinar. So we're doing all this at the same time, and getting the signature flow through the portal for when people are ready to sign up and reserve their spots. So that's also going on in the background. The other part, well, there's another timeline too. So when we open for investment and we say, hey, okay, usually at the webinar, we'll announce a date. Hey, we're going to be open for investment. It could be a week, 2 weeks from that time.
It's going to be open for them to actually.
Yeah. We will open it at noon on Friday, the 30th.
You can make an actual full on commitment, not a soft commit. You can actually fill out the paperwork, put
the paperwork, sign your name, right. And get reserve your actual spot.
Right.
But something that takes all of the legal paperwork to go through. I can't open bank accounts to receive anybody's money until all the LLC paperwork is all the way through, and then I got to take it into the bank and go through their whole process and sign all their different stuff in order to even open the bank accounts to be able to receive the money. So that's all going on too. While people can be there, we've had instances before where we wanted to go live and let people start committing and reserving their spots, but we didn't have the bank account information from the bank yet or opened yet. So we just, at the end of the whole flow for signing, it says, the last thing is the funding instructions for how to fund your investment.
Right.
Depending on whether it's an IRA investment or trust or whatever type of personal cash type of investment it is. Oftentimes we may even put funding instructions to come soon. And whenever we get the bank account opened and ready for investment, then we'll republish and send that out to people with the instructions. But so these are all different kind of timelines that coincide with the capital raise and what we're telling people.
Right. So a few things. One, just quickly, speaking of institutions that are involved and kind of the coordination of all the different institutions, which is a big part of this and has been a number of discussions previously and newsletters. One type of institution that might be involved is not only maybe the SEC, but also states and their laws and rules and how it is that you open a bank account in one state while you're in another state and wherever you filed the paperwork for the LLC and all of those things can slow those things down. Yeah. When it's quite literally more just a matter of alignment and communication than it is any particular problem or hold up, stuff like that.
Yeah, it just takes time to.
Yeah,
absolutely.
Now, I was going to ask, when we get, what's your, and I understand that all this is fungible, right? I understand this is all malleable. But what's kind of an ideal, just to get to maybe some times, what is from signing the PSA to being able to present let's not even say schedule the webinar. Let's say be able to send it out. What's like an ideal timeline for that? How long would be like, oh my God, everything is just like clicking along?
Ideally, we would be able to do it within the due diligence period. So inside that 30 days, which is tough to do because all the things we've talked about that could be, could be delays with this, that, and the other thing. Ideally, we'd have the investment summary approved by the lawyers, which allows us to schedule the webinar. So, I'd like to be able to release information to investors, the official detailed information to the investors at day 30, and have the webinar at day 37 and open the portal by day 45. for investment and have, in give or take, but because typically it's going to be a 60-day closing. And sometimes it takes 2 weeks for people to move funds.
Yeah.
So if we're going to close right at 60 days, and anybody who's in real estate, you can ask Jen, you could ask anybody, closings that happen on time are amazing because they are 1% of the time. There's always a lender needed this and we had to go back to the seller and he couldn't find it. And so, it took an extra week, tack it on. And then honestly, in our contracts, we always build extensions in for, hey, another 2 weeks if we need it. And that could be for, hey, some investors still have funds coming in. We don't have enough to actually close yet. We build that in to protect that. But it could also be, hey, the lender is not ready to close. We have not gotten the clear to close yet from the lender. They're still doing their internal processes, whatever. We don't have the final approval. Any number of things could cause a delay, or, a hurricane's in the Gulf and nobody can bind insurance right now. So we're definitely not going to buy a property that we don't have insured with a hurricane in the Gulf, something like that. These things happen all the time. So, but basically the goal is obviously to have, actually, this is a good point, to have money coming in by 45 days with 2 weeks of time for people to kind of get their funds in. And I've definitely had funds come in on the day of closing, which put us over the number to be able to close, to wire in the final funds. That is just like, hey, that was IRA funds at that time, but IRA funds can take forever to move. And that in that case it was, and it was like waiting on the last couple of IRA wires to hit the account so that I could go over to the bank and wire the whatever that was the biggest wire I'd ever sent in my life at that point, which is pretty wild. But so this is kind of normal, but that's why we have these extensions built in case we need them.
We start talking to investors. So we have like soft conversations, and then 30 days ideally.
Mm-hmm.
We start kind of push out. They can review it. They have time to look at it. And then they have time to make sure that they can be at the webinar if they can. And then, you don't want to just be like, it's tomorrow. So you give them time. So 37 days. And then you said 8 more days, 45, just kind of nice number.
Yeah. Just go with the
portal, right?
Number, yeah.
Where more people have had a chance, but like you said, all those prefictions, right, that I like to call them, right, have to fall into place, which is we've been pitching this as there's going to be this company.
Yeah, exactly.
Property that you can invest in, and it's going to have a bank account, we promise. But all of those things actually have to become legal.
Coalesce. Yeah, they have to happen.
Yeah. And then guys, anybody who is listening to this and invests with us, if you are wondering like, man, why is it taking forever for the portal? I have seen the pitch deck. I've seen the numbers. I want to invest. Is this just Jordan not getting the portal ready? Maybe, but probably not.
Now, all the appropriate paperwork has to be signed before we can show it to investors and have them actually co-sign basically on the subscription agreement, which is what everybody's kind of paperwork and individual attestations and things like that.
Be somewhere to wire the money. Now, on that note, actually, are there not instances, or am I misremembering, where you can have a repository and then once the attached bank account comes online, it's moved over?
You could. Okay. I could open one. We would be allowed to do that. I prefer not to, just because I don't want it. I don't ever want there to be an accusation of commingling or an accidental commingling of, some people who, big companies who do this have their own, like if CVI was a really big company, I could hold an account that would be like the investors. While we're setting all this up, investors start pouring your money in, and then we would go. And we're not big enough. One, we're not big enough that where we need that. And two, it's just, it's risky, and I don't think we need it at this point.
Right.
Maybe I'll.
Yeah. And then, I mean, you would essentially, if you got to a point, you would essentially be your own escrow almost, essentially.
Right. That's kind of what, exactly. And then that way you're getting close to being your own fund at that point. It was like, hey, just give me money, I'll find a property kind of thing. I did want to talk about one more thing of note for the timeline that as it pertains to investors is, so there's basically 3 numbers in our investment targets in how much capital we need for a property. The first one is the lowest one, and that is what we no kidding need to close on this property. Like if I'm waiting on that last $50,000 to hit the morning of closing, so that I can go wire in the money required to close. What is that number? So we'll set that number, and then there's the ideal target number. And it could be, could be really close to that number. It could be, depending on the size of the investment, who knows? It could be, big difference. Maybe there's a big CapEx budget that we have to keep raising. But
yeah, that's going to be the big thing, right? If there's a big renovation or CapEx budget.
Sure. Or maybe we just feel like we gotta, it's very vacant, so we need to have
That's
reserves, something like that. Any number of things depending on the business plan. But once I cannot touch any investor money until we get to that minimum closing amount. So if we can't ever get to that minimum closing amount and we don't close, there's never any risk to the investor money, I guess, is what I wanted to say. So really our kind of first hurdle is getting the closing money. Cool. Then we'll go to our target. This is what we ideally want for this property, what we think for the business plan. And then we'll have like a high end cap. And that's basically if we, during all this process, we discover that we might need to take a little bit more money for reserves. We didn't get the loan that we wanted, or any number of other contingencies pop up. We're allowed to take a little more than our target. Let's say we want to raise $3 million. Set the high end at like 3.5, just in case something comes up during the process. Even though our target is only 3, we'll set our minimum at 2.5. That's what we need to close. Whatever it might be. We'll give ourselves some leeway. And then as we get closer to closing on the property, we'll close on the property, and we're allowed, as long as we close, we're allowed to keep raising money towards whatever until, we hit that very high end. And we'll cut it off whenever we hit the target per what we know at that time. And we're allowed to raise funds up to that high end total max for a whole year after the initial offering is made. So let's say something pops up, we find a building foundation is collapsing in month 4 of owning the property. We're legally allowed to go back out and say, hey, we got to raise another $200,000 to get this foundation fixed. It wasn't in the budget. We did not know about it, but we're allowed to go do that. If, let's say, we hadn't hit that 3 in our scenario here, we hadn't hit that 3.5 yet, we're allowed to go back and raise a little bit more in that first year.
Do you have to declare that high target number?
Yeah.
Where do you declare that high target number? In the PPM?
Yes. There's 3 numbers in the PPM. There's the target to be able to close, the actual preferred target, like what we actually think we want, and then there's the minimum to close target, and then the high end. So we're not allowed to take more than the high end. We basically cap ourselves, but we do want to give ourselves leeway in case of that scenario we talked about.
Yeah, I got to say, I don't think I knew that there was a written in
It's in the PPM
cap target. And that makes sense, because if you just kept raising, you would continue to
dilute everybody's shares.
Yeah, and you need to get clear, like the max dilution.
Yeah, they're basically setting that top end is basically telling them how much risk there is to dilution of their shares as they purchase. Here's what we want, but I'm allowed to legally, because of things I may not have known, raise up to this number, which would dilute your shares XYZ amount. So it's basically a disclosure to the investors. Granted, I think I've only gone less than my target date. I don't think I've ever gone over my target number.
Yeah, I know in the ones I've been involved in, it's never even really come up.
But it's a good safety to have in the event that there is something that was not disclosed to you. Maybe there's some, who knows, legal action, whatever, that needs to happen because the seller didn't disclose something, and maybe it's his fault, but we got to pay for the lawyers now. And you don't want to put the entire investment, because we've closed, right? We don't want to put the whole investment at risk because of this thing we didn't know about. We want to be able to save the investment with additional capital if we need to. And they give us a year from the initial date.
Right. And to be clear, this year and the cap is for this original capital raise, capital call agreement.
Right.
It is possible to actually go out and raise more money, but it's a whole other process. You're issuing different kind of shares with different terms that you have to get approval. There's all kinds of other things going on. This is basically a flexibility in the original contract that says you can keep raising for a year and or to that target.
A little bit of a tangent, but good to know.
Yeah, I think that obviously, first of all, it's best never to have to go to that target. Less capital in the deal, the better, right?
Yeah, everybody does.
And I think I just want to make clear. So closing is essentially the same thing as everyone knows who's bought a house. We have the amount of money for the down payment and closing costs. Here you go, bank.
Yep.
Give us the loan and the deed and the title, and let's get all this stuff going. And then Every dollar after that is either CapEx, acquisition fee, reserves,
Exactly.
all those kind of things that are additional. So, I mean, for instance, it definitely is a scenario where we close on it, and then the syndicate team's just not getting anything until raise is done.
Sure.
Type thing.
Yeah, we're the last ones to get paid always. That's correct.
Exactly. So that target close, it's funny because that moment is a good moment when you hit that, right? Because then you know probably even if the lender's not ready or you don't hit that actual closing date, you don't want to be in a scenario where the lender's not ready and you're relieved because you haven't hit the close. It's way better to be in, and this has happened. I think it was supposed to actually close we had the money and we were excited. I was like, oh, it's gonna be on my birthday, just joking around. And then like the lender's like, no, we're not ready. It was like a week later. I was like, well, that's not as exciting at all. But
really anticlimactic.
Yeah, it's way better to be in that scenario than
to be the other way around. Yeah,
exactly.
For sure.
Yeah. So I was just going to say that 45, it's open, kind of 2 weeks to get the money. That would be entirely ideal. Essentially, you open the portal and you close it 2 weeks later. You're like, we're good. We got all the money. Thanks, guys. Appreciate it. But I just want to back up and make sure that we're clear on this. So during the due diligence, that is information gathering from all institutions. We're coordinating and talking to all of them. Right. And that's where we kind of go dark, honestly. We say, we have a property. Yay. And then nothing. And then hopefully within 30 days, it's, we pop our
We're
heads
about
back
ready.
For
here's some cool paperwork and we're scheduling a webinar. That exactly.
Yeah, exactly. And here you can go onto a platform, look at things, etc. And then that's really when all the conversations and the kind of things that we've talked about before really kick off.
Mm-hmm. Exactly.
And all the fun logistics of getting people's money and wherever it's from.
Yeah, figuring out how to wire.
Explaining them how to do
and
that.
then working with IRA companies, and some of them are definitely better than others.
Yeah, and then ensuring that, honestly, some of our own platforms are coordinating with one another.
Sure.
Becomes part of this as well. That becomes way more just communication rather than information gathering and sharing. It's really just, So that's the big phase, is at 30. And then I think from that point on, most people listening, most investors they're like, yeah, I know that part because, we're hearing from you constantly.
Sure.
But speaking of hearing from us constantly, we're going to wrap it up here. As always, we appreciate you guys listening, whether that is streaming it from Substack or Spotify or YouTube or downloading it or Apple Podcasts, wherever you are engaging. We really appreciate it. And we really appreciate any feedback, comments, questions that you have. If you want to get involved in what we've got going on and you're not in the investor pool, please reach out, comment on the bottom of this and on any of the platforms. You can email both of us at our first names at capitalvelocityinvestments.com. You can go to the website. We'd love to hear from you. But for now, we're going to get out of here. As always, we appreciate you hanging out. We hope you come back and do the same next week on another edition of the Get Invested podcast.
See ya.